that I got my magic marker, I can continue with the most important picture for this course. It's very simple, it's very easy, and will help you to understand commercial and central banking. It is called the monetary pyramid. Well, what is the monetary pyramid? It shows the monetary system as a pyramid. The pyramid looks like this. Guys. We're getting very important stuff, which is gold. The next piece of the pyramid is banknotes. And the last piece of the pyramid are deposits. So, what is the central bank? The central bank centralizes reserves in the form of gold and issues banknotes. So, let's use my color here. This here will be, this piece of the pyramid is the central bank. I'll just write it. Central bank. So this piece is the central bank. Here, this part of the central bank is the asset, which is reserve. Okay. And this part here is the liability. Okay. So the banknotes are commercial banks' liabilities. Okay, I can use this a little bit better. This. So banknotes are commercial, central banks' liabilities, and it's got a gold. Okay, that's what it represents. Now, the question is, what is the commercial bank? And the commercial bank will be this part over here. These two pieces represent commercial banks. Banknotes are assets and represent reserves. Now, these banknotes will be usually held in the central bank, it doesn't matter, or at vault cash, again it doesn't matter, but banknotes will be central bank's liabilities and commercial bank's assets, and commercial banks will create loans and deposits on top of these. So this represents the liability of a commercial bank. Okay. Remember when we started early on, we said that cash is the commercial bank. Let me write it out just to make sure. Commercial banks. So this piece here represents the central banking part, and this piece here represents the commercial banking part. Okay, is this picture fairly clear? Right. Now I'm beginning to answer some of his questions. First question. Suppose we have 100% reserve banking. This means that deposits will be equal to banknotes. They keep 100% of deposit equal to banknote, and I'll add them two pieces at the same time. You have 100% reserve central bank. What is the pyramid going to look like? The pyramid will be gold. On top of gold, you're going to have exactly the same amount of banknotes, and you have exactly the same amount of deposits. So, if you have, let's say, $1 million equivalent of gold, the central bank will issue $1 million equivalent of banknotes, and then commercial banks will issue $1 million of deposits. Now, suppose we have a 100% reserve commercial bank, okay? And the central bank will have twice more banknotes. What is the pyramid going to look like? It's going to look like this. This will be the gold part. This will be the banknote part. And this will be the deposit part. Alright, so we're going to have here gold, banknotes, deposits. Alright, so this picture represents, let's put a label on it, 100% reserve central banking. Okay? And then we say 100% reserve commercial banking. When you have 100% reserve, you don't have a pyramid going like this up. You got straight line. In other words, the banknote quantity is equal to the same as gold, and the deposit quantity is equal to the same as banknote. Here, you have, let's write it out, fractional reserve central bank, and this becomes 100% reserve commercial banking system. Okay. Well, what's next? Next could be the opposite. Next could be the opposite. You may have gold, then you have 100% reserve bank notes. So this is 100% reserve central bank, and then you have fractional reserve commercial banking system. Commercial banking system, okay? Is that now fairly clear? Is the picture fairly clear? So, this means this is the banknote and the commercial banking system is on top. These are the deposits. This is the same number of banknotes as in gold. This is a lot more deposits than banknotes. And now we come to how do these look on a picture? How do these look on a picture? Now we're going to get the multiplier stuff. Let's do the following. You have a particular base. This is the base of gold. Okay. And, well, I gotta make a smaller base, okay? This is the base of gold. And you have 50% reserve central bank. The central bank will have twice. We'll have twice the banknotes. Okay. And commercial banks, again, let's do this again here. Commercial banks will have 50%. So it's going to look like this. Okay. This is gold. Now we have banknotes. And these are deposits. What if we increase the multiplier to 3? In other words, reduce the fractional reserve from 50 to, let's say, 33%. Well, red color, the system will begin to look like this. The pyramid is going to get wider at the top and narrower at the bottom. Okay. And if the, let's say the reserve system is like 10 to 1, if the reserve is 10 to 1, the monetary system can actually look like this. And then like this. We're going to have only, let's say, 1,000 units of gold. You're going to have 10,000 units of banknotes. You're going to have 100,000 units of deposit. Okay, I'll shorten them DD, which stands for demand deposits. Alright? So, the pyramid gets wider and wider and wider as the multiplier increases. Now, let's begin to do a little bit of the arrows. Suppose that you take a demand deposit and convert to cash. What happens? Now, the banknote, which is in the monetary banking system, that's part of the central bank and part of the commercial bank. Let's say you take your money out. This money, which is a deposit before, okay, so you convert the deposit to cash, and you take the cash out of the banking system. So, that piece of cash here is demand for money. Well, what's going to happen with the deposit? The deposits, if this is withdrawn as cash, think of it $1,000 of cash. What's got to happen to demand deposits? Demand deposits got to shrink correspondingly. Okay. So, it's very simple. A small conversion from the $100,000, a small conversion of cash will shrink and straighten up the pyramid. Now, the next thing is, again, very simple. Let's write a picture. This type of pyramid is stable. It's a very small multiplier. This type of pyramid is unstable. Unstable. Okay. So, basically what happens is, you just take a little bit of money out, okay, and this is the result. Now, imagine you're taking, instead of, okay, I should have done something different. All right, let's do this. We'll have the same thing, but we'll have a $500, okay? Let's just do $500. All right? So, I'm going to do the same thing. It's 10,000. This is the pyramid. And you slice $500 out of the pyramid. This is converting deposit to cash. A small deposit, converting a small deposit into cash, means that the pyramid has got to straighten out a lot. Now, think of the next possibility. You take a $500 deposit and you want to convert it to gold. What's going to happen? You got only $1,000 of gold. If you want to convert 500 into gold, you literally got to take half of the gold. And then you literally got to take half of the banknotes to maintain 10-to-1 ratio. And then you literally got to take half of the deposit. So the whole banking system suddenly will shrink a lot. Half the money, meaning the banknotes, half the cash, half the deposit, demand deposits disappear. This is highly, highly deflationary. All right? So this is how it works. So you may get a banknote. So when you take money out, when you take your deposit, it goes like this. This is the process of converting deposit into cash. And now this is the process of converting cash into gold. Okay? Now, people converting massively, when people go ahead and convert massively deposits into banknotes. In other words, you go and take your money out of the commercial bank. We call this a bank run. Bank run. Which back in the old days literally meant you run to the bank and you take your deposit out. Well, when you take it out, you take it out as cash. So, a bank run, the good definition, is a sudden loss of confidence in a commercial bank or in commercial banks, and a massive withdrawal of deposits from the banks. So, people lose confidence, that's the psychological, and then they go and take their money out. That's a bank run. A bank run is a conversion of deposits to cash, to banknotes. Now, you may have the next phase. The next phase is called a central bank run. We are witnessing something very similar today in China, as we read before, where people are losing confidence first in the Chinese commercial banking system. So they're taking their money out of the Chinese commercial banking system, but they're also losing confidence in Chinese currency, the yuan. So they are taking their money out of the banking system. They can take the Chinese currency. Then they convert the currency to the reserve. For the Chinese central bank, the reserve is dollars. And then they take their dollars out of the Chinese financial system and deposit it in Hong Kong or Singapore or London or any other place on earth except China. Okay? So this becomes a central bank run. Central bank run is a sudden loss of confidence in the liability, meaning banknotes of a central bank, and conversion to the central bank reserves. If it's gold, you convert it to gold. In other words, you go to shop and buy gold. If it's dollars, you go to an exchange and you buy dollars. Okay? So, a bank run is deflationary. A bank run means rising demand for cash and falling demand for deposits, okay? And central bank run is highly deflationary. When the central bank run is successful, it results in the collapse of the central bank, in the collapse of the whole commercial banking system. We call this monetary system. Okay, let's write it out. Let's write it out. Monetary system consists of central banking system plus commercial banking system. It's not quite exactly in the textbook, I'm adding bits and pieces for you to understand. But this is the best, simplest, and easiest way to understand commercial. Now, in more advanced courses in investments, we can add on top of demand deposits the investments layer, stocks, bonds. On top of them, we add derivatives, but that's not for the very first course in money, banking, and finance. All right, so central banking is highly deflationary. Central bank run is devastating for the central bank, for the commercial banks, for the government, for the economy. All governments in the world are desperate under any circumstances to avoid a central bank run. Usually they do it by law. They say, it is impossible. You cannot do it. You try to do it, you go to jail. Or they'll just easily shut down the central bank. All right? And that's how it works, okay? Well, as soon as they shut down the central bank, what you get is a black market. The black market will develop, and as in Venezuela, the central bank will have one exchange rate, and you can't exchange much if you want, and there's going to be a black market which will develop on its own. But that's the important point. All right, we call this central bank run this is the same for the central bank. It's called a currency run. You don't like the local currency? You convert it for some other currency. Maybe dollars, maybe gold, maybe euro, something else which consumers, people believe is more stable than the local currency. This currency run is also known, of course, as run on the currency. All right. At least we still got a little power over here, so it's a run on the currency. A bank run is called a run on the bank. All right. And now let's see what else I have here. So a little bit of this is covered here. Now, when we say central bank bailout, all right, when a central bank got a currency run, okay, and the central bank is close to bankruptcy, you will get what's called an international bailout. They will go to some other government, maybe the Chinese government, maybe the American government, maybe the International Monetary Fund, to give them a loan, meaning more reserves to, we say, defend the currency. Okay, defend the currency. Defend the currency. Defending the currency is an attempt by the central bank, monetary authorities, and the government to maintain as high as possible the value of the currency and confidence in it. Because all of these runs are a result of a loss of confidence. So the government is going to defend the currency, okay? Well, the government, so it will get a bailout. For example, the great banking system was in trouble, okay? And as a result, the commercial banks ran out of money, and the central bank ran out of money, so they had to get the European Union bailout, okay? Now, similarly, like international institutions will provide reserves to the central bank, and then the central bank will feed the reserves to commercial banks. Commercial banks can get a bailout from the central bank. This function is known as, red color again, LLR. LLR is lender of last resort. Let's write it out. In other words, when a commercial central bank gets in trouble, it will go to the central bank for a bailout. The central bank becomes the lender of last resort. In other words, the commercial bank says, we are running out of cash, and the central bank will lend cash to it. Okay? They will lend cash to it. What may happen is they may have to print the cash and lend it out. Okay? So sometimes, and I'll explain in other cases, lender of last resort, that's on page 133. Page 133. Now, currency run, I've taken a note, is somewhere on page 132. All right, and the next topic I covered last time is page 133 again. Page 133. This is the uniform credit expansion. Back to central banking. One of the main functions of the central bank is to maintain a uniform expansion of credit. As the textbook says, this is the same as commercial banks expand together. In other words, if the central bank increases reserves to commercial banks to one or more commercial banks by, let's say, 7%, all commercial banks will expand and grow at roughly about 7%. You won't have the case where one commercial bank will expand with 25 and another with 5. If that's the case, the fast expanding commercial bank will lose reserves to the slow expanding commercial bank. So they expand together. That's page 133. 133. And the way, again, the author says it, they'll expand, that's the very last paragraph, harmoniously and uniformly. Harmoniously and this is the last paragraph of page 133. Now, the question is, how does the central bank accomplish this? Last time, required rates of reserves. If the central bank requires exactly the same reserve ratio from all commercial banks, and the ratio is sufficiently high, and all commercial banks alone, that whatever amount of reserves are created in the system, all commercial banks will expand uniformly. Now, maybe one commercial bank will grow at 6 and another at 8, and a third one at 7. But the differences between growth rates of commercial banks will be minor. All right, let's see what else I have. So, again, I wrote it last time. The central bank functions as one of the main functions as a bank of cartelizing. Cartelization of banking system. In other words, one of the main purposes of the central bank was to cartelize. That's page 134. It did so by licensing. That's number one. Number two, it forces all commercial banks to behave similarly, almost the same, through regulations. And imposes harmonious and uniform expansion of credit through required rates of reserves. And the required rates of reserves, there's 134. Page 134. The next page, 136, I discussed the MN, that's the money multiplier from last time, which is 1 over the reserve requirement, R, required reserves, okay? And next, again, page 136, I already discussed last time, is money supply equals cash plus, okay, let me write it short. Demand deposits, which is cash. Now, what is the demand deposit? Will be multiplier multiplied reserves. Let's see what else I got here. Now, next page 136 will be reserves. Reserves, minimum required reserves, which commercial banks must maintain, are just called required. Because required reserves, we've studied that. Now, a commercial bank may be required to maintain only 10% reserve, but a commercial bank can decide and maintain 15 because it wants to, because it likes to, because it fears of something, or for any reasons. So, that extra reserves is called excess. Excess reserves. So, excess reserves are reserves which a commercial bank maintains above and beyond the minimum. If the minimum is 10 and they maintain 12, the excess reserve is 2. Okay. And now, we call the sum of these two total reserves. Okay? So, the commercial bank maintains 12% total reserves, 10 required, 2 excess. Excess reserves, page 136. Okay. And now I get the next